What's up guys, and welcome back to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. In today's video, we're going to talk about one of the biggest alleged market manipulations in recent history. And no, we're not talking about GameStop and AMC. This market manipulation was a sophisticated and organized operation carried out by a large and powerful organization. The manipulation went on for an astounding 7 years and wasn't uncovered by authorities until more than a decade after the practice was started. It affected developed markets in US Treasury bonds as well as metal commodity futures. The perpetrator was none other than the biggest bank in the US, the blue-chip Dow component JP Morgan. As recently as late 2020, they were fined a record fine of almost $1 billion. In any other industry, an institution as big as JP Morgan being fined such a large sum due to illegal market manipulation or a similar crime would be jaw-dropping. But on Wall Street, such penalties for the big banks almost seem commonplace and barely ever make headlines. In today's video, we're going to shine the spotlight back on JP Morgan and its infamous trading activities, so we can understand what Wall Street tries so hard to cover up. Market manipulation perpetrated by JP Morgan first came to light in late 2019, when it was revealed that the Justice Department had charged 3 of JP Morgan's traders with spoofing precious metals markets.
3 JP Morgan metals traders have been charged with alleged market manipulation. Wilfred, you've been digging into this story all day.
Yeah, so 2 current and 1 former JP Morgan precious metals traders have each been charged with alleged spoofing, market manipulation, and fraud between 2008 and 2016.
Spoofing is an advanced market manipulation technique that can only be effectively implemented by market participants who have a lot of capital and very low latency access to the markets. In addition, they must have sophisticated trading logic. Without sophisticated strategies or experienced full-time traders, just having a lot of capital and quick access to the markets is not enough. In its most general definition, spoofing is any trading activity where orders are submitted to exchanges which are not intended to be filled. It was defined in the Dodd-Frank Wall Street Reform and Consumer Protection Act and again by the Commodity Futures Trading Commission as bidding or offering with the intent to cancel the bid or offer before execution. On its face, a reasonable person might have 2 questions about this definition. One is that just submitting bids or offers, which are just limit orders to buy or sell, seems like a harmless market activity. And the second question is why would someone even submit such an order if they didn't want it to be filled? To answer those questions, we have to look at it from the perspective of a huge institution like JP Morgan placing these trades. JP Morgan is a financial behemoth whose history goes back more than 100 years. They've been operating as a money-making machine for all of those years and have become one of the top few most valuable businesses in the world. In the last fiscal year alone, despite the fact that the COVID-19 pandemic gripped the entire world in a once-in-a-100-year calamity, JP Morgan was able to bring home about $30 billion of net profit. A non-trivial part of JP Morgan's business is trading activities. These trading activities brought in $18 billion of total revenue last year. In comparison, that $18 billion of revenue is on the same order of magnitude as the entire assets under management of Point72, which is one of the world's top hedge funds. So it's safe to say that JP Morgan's trading operations are significant on a global level. When JP Morgan places a trade on an exchange, the amount of money in each trade can easily be in the millions or even tens of millions of dollars of notional. Whenever huge orders are submitted to an exchange and show up as bids or offers to other market participants, you can bet that other traders will take notice. For example, hypothetically, if Company A just released their earnings report in the past 30 seconds, and you then see a huge amount of asks being submitted on the exchange, you might conclude that someone with a lot of money has made a judgment as to whether the earnings release was positive or negative. Given the quick timing of the orders appearing seconds after the earning release, as well as the sheer magnitude of the order, you might think that this market participant is a sophisticated investor, so-called smart money. Because the orders were offers rather than bids, you might also conclude that this sophisticated investor thinks the earnings report was negative and thus is trying to sell their shares before the stock price drops. In response, it would be natural to not want to buy shares at this time, and you might even want to sell some shares if the price hasn't moved yet. In this way, the unfilled orders that the mysterious market participant submitted to the exchange affected the other traders in the market. That's by no means the only way that spoofing can happen, and in fact, usually spoofing takes on much more subtle and sophisticated realizations. Sometimes, spoofing can be even carried out by completely automated algorithms without any human ever knowing about it. For example, an area of artificial intelligence and machine learning called reinforcement learning allows a computer to take specific actions and receive feedback after each action. In the financial markets, these actions could be submitting orders to an exchange, and the feedback could be the profit earned on each closed trade. Over the course of thousands of actions and resulting feedback, the machine learning algorithm learns what actions to take in any given environment to maximize the feedback reward. It's very possible for an algorithm like this to eventually learn a spoofing strategy on its own, without human design or intervention. Moreover, reinforcement learning has certainly been used by sophisticated institutions to create automated trading systems. So now we know what spoofing is. In at least the 8-year period from July 2007 to August 2016, JP Morgan's traders repeatedly engaged in concerted strategies to spoof precious metals markets. Eventually, the Department of Justice, with assistance from the FBI, discovered the spoofing and were able to charge a particular trader from within JP Morgan with market manipulation. His name was Christian Truns, age 34 at the time, from London. Truns pleaded guilty to one count of spoofing and another count of conspiring to spoof markets for gold, silver, platinum, and palladium futures. According to a Department of Justice press release, Truns learned how to profitably spoof the markets from more senior traders at his company, and actively engaged in spoofing with the knowledge and consent of his supervisors. 2 days afterwards, the Department of Justice expanded its target to 3 other traders at JP Morgan: Greg Smith, Michael Nowak, and Christopher Jordan. Like Truns, these traders manipulated the precious metals futures exchanges over the course of at least 8 years, racking up thousands of illegal trades. All 3 of them were charged with conspiracy to conduct the affairs of an enterprise through a pattern of racketeering activity. However, they were also charged with wire fraud, bank fraud, commodities fraud, price manipulation, and spoofing. 3 months later, the Department of Justice expanded its target again to include Jeffrey Ruffo from New Jersey and also a former employee at JP Morgan. The charges against Ruffo were as wide-ranging as for the previous 3 traders charged. In the Department of Justice's press release, they described the strategy that Ruffo and his co-conspirators used in their spoofing activities. While placing trades for clients on the precious metals desk at JP Morgan, they would submit orders to buy or sell a futures contract at a certain price, attempting to get good execution quality on their order. They would then place a large amount of orders on the opposite side of the trade in order to either create the illusion of liquidity in the markets, or to mislead other market participants about the true supply-demand relationship of a given futures contract. These are called deceptive orders, and were used to inject false or misleading information about the true equilibrium market prices of the securities. According to the Department of Justice, this misleading information in the form of a spoofed order book was successful in causing other market participants to react to the apparent changes in the supply-demand relationship. This meant that other market participants ended up buying or selling contracts at either quantities, prices, or times that they otherwise would have been unlikely to. JP Morgan did not spoof the markets to directly profit themselves in this case. Instead, they did so on behalf of their hedge fund clients. For example, when a hedge fund client wanted JP Morgan to place an order to buy a futures contract on a precious metal on the hedge fund's behalf, the trader at JP Morgan would then call up another JP Morgan trader, alerting them of the trade. The other trader would then place the spoofed orders on the same security, driving the price of the security up or down favorably for the hedge fund client. By getting good order execution on the trade as a result of JP Morgan's spoofing, the hedge fund clients would continue to do business with JP Morgan as opposed to going to a competing prime broker. Hedge funds placing trades with big banks like this is an important source of revenue for JP Morgan and other prime brokers, and is a source of a large portion of their total trading revenue. Without them, trading operations at large investment banks would likely be unprofitable. Perhaps even more blatantly manipulative of markets in a way that directly benefits JP Morgan was through what is called barrier running and barrier defending. In this illegal activity, a hedge fund client or other institutional investor comes to JP Morgan wanting to trade what is called a barrier option. These are a special type of option that have a binary outcome. In other words, they pay out a set amount if the underlying security exceeds a certain price at expiry, and pay out nothing if the underlying does not. Because the difference in payout is so great when the underlying security is near the barrier price, JP Morgan engaged in using their spoofing strategies to manipulate the securities prices either up or down depending on which side of the trade that they took. As a result, if the barrier option was on the fence and looking like it could go either way, JP Morgan would manipulate the markets in their favor. For example, if a hedge fund wanted to take a position that the price of gold would be greater than $1,700 per ounce, they might ask JP Morgan to write a barrier option. At a set date, if the price of gold was indeed above $1,700 per ounce, the hedge fund would receive an amount of money from JP Morgan, and if the price of gold was not above $1,700, the hedge fund would receive nothing. To enter into the trade, the hedge fund would pay JP Morgan some amount of money up front. If, leading up to the expiration date of the option, gold was at, let's say, $1,705, JP Morgan would try to get it down below $1,700 so that they would not have to pay the hedge fund. That's where their spoofing expertise comes in. This practice of barrier running and barrier defending directly pitted JP Morgan against its own clients. However, since the clients were trading directly with JP Morgan, and because so much money was at stake, JP Morgan was incentivized to do whatever they could not to lose in the trade. Although the Justice Department up until 2018 only charged individual traders at JP Morgan with spoofing, in September of 2020, they announced that they had successfully settled with the bank itself. JP Morgan had agreed to pay $920 million in connection with its spoofing schemes. The bank also admitted that it had engaged in the illicit behavior, which is worth noting because frequently, big banks settle with regulators without either admitting or denying the allegations. Although the settlement was a record for the Commodity Futures Trading Commission and the second biggest civil settlement in American history, it was little more than a drop in the bucket for JP Morgan. In the same quarter that the settlement was announced, JP Morgan made an announcement of its own, reporting record-high corporate profit of $12.1 billion in that quarter alone. Based on that quarterly profit, JP Morgan would have been able to pay off the entire record $920 million penalty in less than 5 trading days. Another fact that has been largely missed by the sparse media coverage of the JP Morgan spoofing scandal is that the traders indicted by the Department of Justice were quite high-ranking employees within the company. For example, of the 5 traders charged over the course of the Justice Department investigation, 4 of them were executive directors at JP Morgan. The 5th trader, Michael Nowak, was a managing director and actually ran JP Morgan's global precious metals trading desk. Sometimes it seems like the big banks, or the media, or even the regulators themselves want to pin these market manipulation crimes on a few bad apples within the companies. The CEOs of the companies usually deny that they even knew of the illegal behavior, and the companies are quick to condemn the actions of the traders directly placing the trades. But if the person spoofing the markets and manipulating futures contract prices is a full-time employee of the company, is placing trades on behalf of the company, and the company has long been the entity benefiting from the illegal profits of the manipulation, then the crimes are a reflection on the company itself. Michael Nowak, one of the traders who pled guilty to the charges, had been working at JP Morgan for more than 23 years. He was pretty much in charge of the entirety of JP Morgan's global precious metals trading operations. In essence, he was the face of the company when it comes to precious metals trading. In the end, the bank itself was the entity that had to pay the fine, not the traders. But the sad thing is that Wall Street megacorporations have been paying fines like this one left and right for decades and still engage in illegal activities. These fines don't seem to have any effect in deterring Wall Street's heavyweights. And unless the magnitude of these fines starts being meaningful on the level of these companies' actual profits, or the authorities start really going for those at the top of the organizations, there's no reason to be hopeful that these banks will ever stop. Alright guys, that wraps it up for this video. If you like the content, make sure to smash that like button and subscribe for future videos. Also, leave a comment letting us know what you think the regulators should do to prevent the banks from continuing their illegal profiteering. Also check out our second channel, The Economic Outlook, where we post videos on all sorts of interesting economic topics. In the meantime, thank you so much for watching and we'll see you in the next video. Wall Street Millennial, signing out.